You ever look at a fast-growing stock and just wonder, is this thing a rocket ship I should jump on, or is it just dangerously overpriced? Well, today, we're going to unlock a really simple but super powerful tool that can help you figure that out. Okay, so picture this. A stock you absolutely love, maybe one of the big AI names, suddenly tanks 20%. Your gut is screaming, buy the dip, this is the chance. But your brain, it's asking that nagging question. Is this a real opportunity to get a great company on sale, or am I about to walk right into a classic value trap?
And this is exactly where the usual tools, like the PE ratio, can totally fool you. I mean, you see a stock with a low PE, and you think, hey, that's a bargain. But what if its growth is just completely stalled out? It might not be a bargain at all, just a failing business. That's the value trap. Then you see another stock with a sky-high PE, and it looks way too expensive. But what if it's growing its earnings by, say, 40% a year? The PE ratio by itself just doesn't tell you the whole story.
But what if I told you there's a way to add that missing piece of the puzzle? A way to connect a company's price to its real-world performance with just one simple number.
And that number is the PEG ratio. It is a fantastic little tool that helps us understand if we're actually paying a fair price for a company's future growth.
So what is it? The price-to-earnings growth, or PEG ratio, does exactly what its name suggests. It takes that PE ratio we all know and adds a really crucial layer of context, the company's expected earnings growth rate. It helps us answer a better question. Not just, is this stock cheap, but is this stock cheap relative to how fast it's growing?
And seriously, the calculation could not be easier. You just find the company's PE ratio, and then you divide it by the annual earnings growth rate. That's it. That one little bit of division can make a world of difference.
Okay, so what does the answer actually tell us? Well, the general rule of thumb is if you get a PEG ratio under 1, that suggests the stock could be undervalued. You might be getting a discount on that growth.
Now, a PEG of exactly 1, that's kind of the gold standard for a fairly valued stock. It means its price and its growth are pretty much in perfect balance.
And you guessed it, if the PEG is over 1, the stock might be overvalued. This could mean investors are paying a big premium for future growth, which, can be a bit risky.
Now, this isn't just some random formula somebody made up. It's actually the cornerstone of a really famous investment philosophy, one that was used by some of the greatest investors who ever lived.
It's called GARP, which stands for Growth at a Reasonable Price. And the idea is just so simple and intuitive. Don't just chase after explosive growth no matter the cost. And don't just buy cheap stocks that are going nowhere. The goal is to find that sweet spot, to find amazing growth at a price that actually makes sense.
The legendary investor Peter Lynch really brought this idea into the mainstream with a beautiful, simple rule. He said that a fairly priced company will have a PE ratio that's equal to its growth rate. Think about that for a second. If a company has a PE of 20, it should be growing at 20%. And hey, what's 20 divided by 20? It's 1, a PEG ratio of 1. See how it all connects?
Another investing giant, Jim Slater, took it even further. He was on the hunt for what he called rare gems, and for him, that meant a PEG of 0.66 or even less. Now, why so low? He wanted a margin of safety, because look, that growth rate is just an estimate, right? So by paying less, you build yourself a cushion just in case those forecasts are a little too optimistic.
All right, so that's all the theory. But how does this actually hold up in the real world, with the stocks that we're all watching right now? Let's put the PEG ratio to the test and look at some of today's biggest tech giants.
Okay, let's take a look at some names you'll definitely recognize. Here we've got their forward PE, their estimated 5-year earnings growth, and the all-important PEG ratio. Just scanning down that last column, you can immediately spot some huge differences in how these companies are valued. And this chart, wow, this chart really tells the story, doesn't it? I mean, look at NVIDIA. Even with its mind-blowing growth, its PEG ratio is just 0.55. That's deep in bargain territory according to this metric. Then you have Amazon, right around fair value at 1.05. It's just amazing how this one number helps us see how differently the market is pricing the growth of these massive companies.
So how does this actually help us? Well, for a company like NVIDIA, a low PEG could signal what some people call a valuation gap, where the stock price just hasn't caught up to its incredible AI potential. For a company like Broadcom, a low PEG might reflect how stable its business is. It's like the essential plumbing of AI with these super sticky contracts. And for Meta, a low PEG is backed by a fortress of a balance sheet, which lets it buy back its own shares and support the price. The PEG ratio is really the starting point for digging into these stories. But hold on, before you run off and start searching for low-peg stocks, we've got to have a little chat. This tool is incredibly powerful, but it is not a magic bullet. It has some really important limitations you absolutely need to know about.
First, and this is the big one, the G for growth in the PEG ratio, it's based on analysts' estimates of the future. And let's be honest, analysts can be wrong. A lot. Second, what's considered a normal PEG can be totally different from one industry to the next. And finally, the simple version we've talked about completely ignores dividends, which for a lot of companies are a huge part of your total return.
So here's a final pro tip for you. When you see a PEG ratio listed somewhere, always check if it's a forward PEG, which uses future estimates, or a trailing PEG, which uses past growth. When you're trying to figure out what a company is worth, the forward PEG is almost always what you want to look at. Just always remember, it's based on a prediction.
Which brings us right back to where we started. The PEG ratio can be an amazing guide. It can point you toward a potential bargain and give you some hard data to back up that gut feeling. But even when all the numbers line up perfectly, the final question is always the same. Do you have the conviction to actually pull the trigger? And that, well, that's something no formula can ever answer for you.